Well, welcome everybody to the August edition of the Roundtable tonight. My name is Mark Robertson. I'm joined here with my friends Ken Cavola. You can see Ken there on the left in the lower end of the Mexican Peninsula there. Tonight, the role of Cy Lynch is going to be played by Herb Lemcool, our good friend from the northern Michigan area. Herb is the second guy in on the left down there. Hugh McManus is, there's a very low probability that he will be able to join us tonight. He may, but he is currently engaged in business travel, so we'll cross our fingers and hope that he is able to make it, but otherwise we'll pinch hit for him. But again, welcome everybody, especially a heartfelt welcome to anybody who may be here for the first time. We do make these slides available either by email or by, they are made available on the Manifest Investing Forum. We might talk a little bit more about that as we go. But let's just go ahead and get into it. And by the way, there is no connection between hot air. That's actually a map of the hurricane and wave height. It's not a hot air thing here. We hope that you guys will hold back on the jokes. But if you do have any comments or questions about future sessions, Ken's email address is there in the lower right-hand corner, kcabula1@comcast.net. Let's kind of get underway then. Most of you know the drill. No investment recommendation whatsoever is intended by what we do here tonight. Everything we do is for the purposes of demonstration. Herb, Ken, and I may actually be shareholders in the companies that we talk about. We'll try to remember to disclose that when that is the case. But again, everything is here for illustrative purposes and demonstration, and we demand that you do your own homework, make your own decisions. Here's a quick agenda for especially if you may be new here. We'll just kind of kick things off by talking a little bit about what this is all about, where we've been, and where we hope to go. And then we basically just step through a series of some of our favorite stock ideas at this time. Ken will be covering the ticker symbol EGOV. It's actually, the company is National Information Consortium, NIC, but the ticker symbol there is EGOV. Herb is going to kick around LKQ Corporation. That's the automotive repair parts coordinator. Hugh McManus goes back to the well or the trough or whatever with Staples, even though Staples has been absolutely hammered in recent weeks, but that never bothers him. And then I'm going to close things up with Knight Transportation, ticker symbol KNX. We should have time for audience selection and an audience poll tonight. As Pietro was saying, he wanted to, or I can't remember who said, but perhaps some conversation on stocks like Quality Systems and Gentex before the night's over. And we may have some time to do that tonight. Here's just a quick look as to what this is. We've been doing this for a little over 2 years. We are serious about this. What we basically want to do is identify high opportunity stocks for study. We do track them in a portfolio after we bring them. We do attempt to reach out there and find a real opportunity with a incrementally higher return forecast and put them all together. We do want to outperform the market by this 5% that you can see here. That's what we call relative return. That's that age-old 5% that our community has followed. And then we really would like to see basically 3 out of every 5 selections outperform the market after they are selected. That's the outperformance accuracy that you'll hear us talk about. Here's a quick look at how well we've done over the last little over 2 years and change. And you can see that we're not quite where we want to be. We want to get into this zone of being somewhere in this 5% range. And we threatened it a little bit in. Then we had kind of a cold streak. And I have to take personal responsibility for a good part of this. Some of my selections have well, they have not. They're not done yet. I'm not going to say they're failed. They're still. We're still waiting to see wonderful
works in progress, Mark.
They are works in progress. Now, Ken is the one Knight that has a positive relative return. In fact, I believe he's up to almost 2% now. So he has the positive amongst the group. The audience, by the way, the audience selections so far, when the audience has voted, are up here. So again, that's why we love to have you guys vote. But you can see there's a pretty good spread amongst our participants. We've had guest damsels here. We've had guest knights. And we just kind of throw it all up there, and we do like to keep track. I do like the trend that we're seeing here. I think all of my night counterparts also like the trend. They're saying we've seen pretty strong performance from a few different companies like BioReference Labs, even in the face of weaker performance from companies like Staples and one we don't like to think about, Research in Motion. We'll talk a little bit more about that. Again, we've had a little bit under 50% of the selections outperform since selection. Again, we'd like to see that up around 60%. We have every reason to believe that over the long term, we will probably get there. But again, almost too early to call, and I'm sure Ken will second this. If we're out there and we're dealing with a fairly young investment club that is in their second or maybe even third year of operation, we do like to counsel and encourage people to keep track, but when you're in that part of your life as a club or a group of investors, you want to be careful about paying too much attention. And for one thing, you can get discouraged, a little bit too much of this. And so if you're fairly young, you don't want to pay too much attention to that stuff. Just keep picking high-quality companies when they're on sale and just keep doing it, and then come back and talk about performance later. One of the things I thought we would show tonight on this next slide is just what we have done lately, and this is part of that uptick you saw on the previous slide. You see this little uptick here in the last few months where we've been trending up. You see a whole lot of green results. Anything in this relative return column here that is green, it's a selection that has outperformed the market since the time of selection. So you can see there's a whole lot of green going on, and that we love that. Absolutely love that. There's a few that have not done quite so well. Not sure who keeps picking this one, ticker symbol RIMM, but I will point out that it was up 2.5% today. No grief from that? All right.
Well, what's 2% on $10, Mark? Come on.
I know. 2% when you're already down 80%. I guess it just eases the pain a little bit. But you can see Hugh's going to come back and select Staples, which he's selected a couple times here recently, and it's been hurt a little bit lately. I mean, the company's been fairly well damaged, but Hugh has, again, that very long-term perspective. He sees it as opportunity. Plain opportunity. Yes, the fundamentals have been dented, but he's going to come back and go again and just hope that collectively those all go up in the future. You can see that a couple months ago, Ken, myself, and the audience all selected Fossil one night. So we had a three-time winner that one particular evening. But again, the message here is that things have been better here lately, and that we do seem to be headed for positive relative returns again. And again, we've got these going all the way back to the start of this a little over 2 years ago, and we track them very carefully. Here's a look at the tracking portfolio. It's arranged in descending order from largest. In the case of Walgreen, Walgreen has been selected 7 times by us, not always by the same person. So every time we select a company here and put it in the tracking portfolio, we invest $1,000 into it. So $7,000 has been invested in Walgreen, and you can see that it's up to about $7,800. And we'll show the page where these are kept track of, but and how many multiple selections there are for a bunch of these. But you can see how many times they've been selected on the dashboard page for the portfolio, and you can basically see what companies are having the strongest influence on the portfolio. Case in point, BioReference Labs, that's been selected, I believe, 5 times, and you can see it's a little bit above $5,000 here. Well, that went through some pretty metal testing moments towards the end of last year, and we're just elated to see the price go from somewhere around $10 a share up to 27 as of tonight's close. And still looks like it might have some room to run over here. And again, a lot of many community favorites here in the group. Probably a lot of familiarity with many of these companies. Any questions or comments on that, Ken or Herb?
No, there's still some really good ideas on sitting on just this chart. I'm very pleased to see a couple of these with really high pars yet.
And we'll look at a sort by par here in a minute, so we can see that many of them are still look like they're they're positioned pretty well.
I notice Apple is still one of those with the least amount of shares, but almost as much money as everything else. So.
Yeah, Apple's only been selected twice. In fact, I came within an eyelash of selecting Apple tonight. I'll explain that later.
I almost did that too. So,
it's just
especially with Samsung being told that they stole all their ideas, and Apple now wants to take all those things off the shelves.
Yeah, that's a real competitive war going on out there for sure.
Yeah.
All right, so again, many household names on that list. In the spirit, or much in the style of our dashboard diagnostic sessions that we hold about once a month, this is what the tracking portfolio looks like. We often get the question, why aren't you guys targeting and selling holdings within the portfolio? Well, first of all, very few of the portfolio holdings have return forecasts even less than the market. Some of them are down near the market, but as we always point out, the portfolio overall projected return for the portfolio checks in at 14.9%, again, in a pretty healthy position with respect to our target range. The short answer is we don't need to sell anything yet, and there's nothing that is an obvious, rip-roaring sell out there, so we just continue to await and patiently wait for the opportunity when we might weed or take some profits or whatever, but we haven't seen that opportunity, at least not blatantly yet. We've had one position that we've closed out in 2 years so far. And really, we are still in that mode of identifying the best opportunities, much like a fairly young investment club or partnership might be. Again, all the other things, quality is fine. It's within range. We've been, even though you hear us say this and you probably are skeptical about believing it, we don't make any conscious effort to sector diversify or distinguish between small, medium, and large companies when we do our shopping. But the four of us and all of our guests know enough that it's important to diversify by size to get a sufficient amount of growth rate in the portfolio. You can see that because we do pick enough smaller and medium-sized companies that the overall growth rate of the portfolio is right in the zone where we want to be. So we get yet another check mark here. Everything else looks pretty good, financially stable and strong companies, relatively straight lines on their visual analysis. So the portfolio looks like it's fairly well positioned going forward. Specifically, and here's what Ken was alluding to, and many times we use this as a place to go shopping. In fact, most of us go shopping here first. This is a look at the holdings of the club and the tracking portfolio, only sorted from top to bottom from highest return forecast by PAR. PAR stands for projected annual return, and you can see that some of those are getting up there fairly high, and then descending down. And most of us, Cy does this almost every month, as does Ken. They'll come down to where they see the potentially too goods to be true kind of wind down into all of these companies that are in the sweet spot. Again, most of these are going to be in buy zones on stock selection guides, and a lot of times Ken and Cy will spend their shopping efforts, in this zone of the spreadsheet sort or the dashboard sort. So, anything there that we should talk about, gentlemen?
Gee, Hogs is in there? I wonder how come Ken didn't bring that up to forward again.
Hey, that's 2 years old now. I learned my lesson on that one, Herb, I'll tell you.
Well, that's another one. I'm still not convinced that we don't just have to wait now that it's there. Just wait it out. And it's one that definitely ran into a kind of a burst of bad luck, if nothing else. Bad press. But we might spend just a moment talking about one of the attendees in the green room talked about maybe a few comments on quality systems. That is the one at the top. It's got the highest return forecast, and that's after, I'm pretty sure that's after toning down some of the fundamentals. A little bit lower growth rate, a little bit lower profitability, and probably even a little bit lower PE compared to what it has been. And even under those conditions, with the price dive over the last several months, the return forecast is in the mid-20s. Now that's in that too good to be true range. I think it may be a little bit oversold at this point. It's hard to know. This is the company that is embroiled in an intense proxy battle. It's only now unraveling so that we're seeing all the details. They They elected a mixed slate of directors, and the turmoil continues. In fact, many people who have been holders of the stock for a long time I'm almost getting the sense they're throwing up their hands and saying, you know what, there are much better opportunities out there. As a case in point, maybe not better companies, or just the chaos and noise is not something you have to put up with when there are so many wonderful investment opportunities out there. As a case in point, at the Challenge Club meeting just last week, we had a 50-50 vote deadlock on selling Quality Systems for that precise reason. I think half the attendees there thought that the company QSII might be oversold and might be too late to sell. The other half were just simply pretty much collectively fed up and wanted to go shopping with those dollars and put them to work elsewhere. Ken or Herb, either one of you, do you have anything you want to add on Quality
Mark,
Systems?
I have a question from Lorraine, and then I have a comment about Quality Systems. Lorraine would like you to go over again what the sweet spot is and how you determine it.
Okay, the sweet spot itself, when we're referring to the sweet spot, we're basically using the projected annual return as our trigger for making a decision. And what we're talking about is we take all, let me go back a couple slides here, one slide. That's what you see up here in the upper left-hand corner. What we do at Manifest Investing is we basically have a continuous analysis of about 2,500 companies. And for all 2,500 companies, we come up with a long-term return forecast. And we take the median, or it's basically pretty close to an average, but it's the median, the middle return forecast, and we call that MyPAR. And that's going to be the median projected annual return for all the companies that we cover. Right now, and this is hot off the press, let's call it 9%. It's approximately 9%. So the average or the median stock out there has a 9% return forecast. What we then do is we say, well, we'd like to do a little bit better than that. What's a little bit? Well, it turns out it's a fairly healthy amount better, but at least 5 percentage points better. But then we also take a step back and say, but we don't want to be greedy. And we say, well, so what we basically end up doing is adding 5 percentage points to that and aiming for 13.8 or 14%, but then not reaching and getting too greedy and going any higher than 19. Anytime a stock is in that plus 5 up to a limit of 10 percentage points higher than the average stock, we color code it in green as is shown here. And going back to this slide, you can see that starting with First Niagara Financial and going all the way up here to Quality Systems, these are more than 10 percentage points greater than the market when it comes to return forecast. All of these down here color-coded in green are in that range of 5 to 10 percentage points above the average stock. So again, we like shopping in this sweet spot, all these green numbers that you see here. Does that help, or anything you want to add to that, Ken? And then go ahead with your...
That's a great explanation. I do have a comment about Quality Systems, and it doesn't talk so much about the proxy fight or about what's going on with the bad will between some of the directors, but I've been recently doing some reading about Quality Systems and trying to think a little bit between the lines of what I'm reading. And I've been quite concerned in the last maybe 6 weeks or 8 weeks by a couple of facts that are about, circling around the company, and then also about a couple of things that are out there being reported. Whether or not they actually are facts, I don't know yet. But the first thing that bothers me a little bit is that Quality Systems seems to be having a little bit more trouble extending their contracts and gaining new contracts. Their competition is heating up, and it appears that some larger companies are beginning to enter the field. Morningstar characterizes Quality Systems as having a very narrow moat, which means it's pretty easy for other companies to become competitive with Quality Systems and enter the same business space. So that bothers me a little bit. The other thing that bothers me about Quality Systems is anecdotal, but I hear that, well, I know for a fact, and I hear that hospitals are increasingly consolidating, and forming very large groups of hospitals within a hospital system. And there's a lot of articles, there's a couple of articles that I've read that indicates that one of the tendencies of these large hospital systems is to create their own internal systems for digitizing the records within the system from the various physicians and all that circles around it. If that's true, then the total number of potential clients, the total number of potential clients is also going to decrease for a small company like Quality Systems. I guess I'm just a little bit antsy about the competitive pressures that this small company is facing as it tries to grow to a mid-sized company. And I'm experienced enough to understand that sometimes you just have to ride a small company for the profit you can get out of it, and then be satisfied with moving away from it if it can't do a good job of moving to the next level as far as growth and profitability and everything else is concerned. I'm just very concerned about all those issues as it pertains to Quality Systems.
Well, one thing I'd like to do, because I think it captures a lot of the spirit of what you just said, Ken, is for those of you that are familiar with manifest investing, I want you to know about this feature. Those of you that are not familiar with manifest investing, if you would like a free trial, but you can basically get a 30 or even 60 or 90-day free trial to check this stuff out. But for those of you that have manifest investing, if you go into any company within stocks, in this case Quality Systems, and you click on this little magnifying glass, you're taken to what I've kind of called our own little Seeking Alpha. This is going to take you to a collection of articles solely about Quality Systems, anything from published articles that we've written down to forum posts. And the reason I bring this up is, again, it becomes quite a resource, and there's a whole bunch of posts here. Takes you right into a post where the people were talking about the company going back over several months. What's going on here? What's going on behind the scenes? There's a look at the fundamentals. And you can see that there's just people jumping in here. Dan Hest shares quite a bit here. Laura Scott, Mark Johnson. And you can see that there's just a whole bunch of stuff here talking about the issues faced by this company in great detail. And in fact, I listened to the latest conference call after Dan made us aware that it was going on. And I came away from that conference call wanting to hear what there's a gentleman on the board of directors. He's been on for years, and he's been kind of turbulent and dissident for years. And after listening to the conference call, I wanted to hear his side of the story. I mean, I want to hear what this Mr. Hussein's concerns are based on that conference call. So you can see there's just a bunch of stuff here, and it's not always that deep for other companies, but this is a case where a lot of people within our community have been digging in and finding information and sharing it. So as a resource, so I think it's pretty cool.
I think it's also a wonderful example, Mark, of this idea that you don't buy and hold something forever, but you buy and you hold it until you can find something that will do better in your own portfolio. Quality Systems was a fantastic investment for a large number of years, and if you don't fall in love with it, then you should be able to walk away from it once the preponderance of evidence tells you that there might be some significant problems with the company.
Absolutely. Yeah, I believe it's still one of the top performing investments in Tom Gardner's stock advisor portfolio. And that's going back 8 or 9 years still, even after the price drop. So with that, we'll probably be talking more about that in the future. In fact, I would expect at a future roundtable that at least one of us, if this company does stabilize, or if it doesn't, I mean, we're going to have to address it. We could be looking at a motion to accumulate more shares of Quality Systems if we see any signs that the company's getting its arms around some of the challenges that Ken was just talking about. So
Mark, Lorraine is asking some questions about manifest investing, and I would encourage Lorraine to go to the website, set up a free trial period, and everything about costs is explained right on the website. The website is manifestinvesting.com, Lorraine, and I go there and get your questions answered. Mary says that she finds it interesting that the director, that Mr. Hussein, that was put on the board is the guy that used to own NextGen and ran that division and then left. So it's not only people from outside that are maybe not in sync with the majority on the board, but there also appears to be some insiders, according to Mary.
Right. In fact, the executive responsible internally for NextGen resigned last week. So, again, all you can do is read between the lines and do your best. All right.
Okay,
well, I think let's go ahead and get into our next part of the presentation. Again, we may have a little bit of time to come back and talk about other things, but Ken wants to talk about NIC, again, ticker symbol EGOV. So take it away,
Mark,
Ken.
if you could throw the screen to me, I'd appreciate it.
Okay, just give me a second here.
Thank you.
Should be coming your way. Take it away, Ken.
Okay.
I can't wait to hear about this company.
I did a little bit of looking at that report card that Mark showed you all, showed the quality of the whole portfolio and the earnings stability and the financial strength and everything. And I looked at the sales number myself. It was 10.8. And I thought that perhaps I would add to that growth a little bit by looking for a smaller company this time. So I went back and did some small company searching. That doesn't mean that it always ends up at the highest quality. Sometimes I'm even willing to move into the 55 to 65 range with quality. But I came up with this company, NIC, ticker EGOV, and it just fits the bill for a very interesting company with not a whole lot written about it at the moment, but with very intriguing metrics on the stock selection guide. So I'm going to present it this evening. The graphics that you see come directly from NIC's website, and this is their home page. This is a particularly easy to navigate website. Whoever designed this obviously does a lot of work with websites, and in fact that is their major business, opening portals that people can use to get information. I'm sorry about that. Something's trying to contact me here. So what does NIC do? Well, it tells you right in that opening paragraph over there on the left-hand side of this page. It builds official websites, online services, and secure payment processing solutions for more than 3,500 federal, state, and local government agencies. And the vast majority of those websites, those portals as they refer to them, the vast majority are at the state level. NIC, boy, I'm going to say that the whole night, aren't I?
Just go with EGOV.
EGOV operates in 30 some odd of the states. The states that are blue right now, that's not Democratic, that's states where EGOV is active and they have active portals. And the 4 red states are states where they have RFPs, that's request for a proposal. In other words, they're negotiating with the state government, and there's a pretty good likelihood that they'll be opening up portals in those 4 states within the next 18 months to 2 years. Their goal, obviously, is to become a nationwide company in every single one of the states and the District of Columbia, and they're well on their way to moving in that direction. I found their business model to be extremely interesting because it doesn't start with the taxpayer. There's no money at all used to open these portals that comes from public funds to begin with. NIC actually upfronts the money for the opening of the portal, once the planning stage has been met. And then if you read down the left-hand side of this slide, you'll see that once they make the upfront investment and fund the ongoing operating and capital costs, that they take a piece of the fees that are generated by these services, and that's how they end up making their money. The more transactions they make, the more money they make, so it's population driven. And once they get these portals set up, the revenue cycle is pretty steady, and they don't have to go out and win back customers on a yearly basis. In fact, they're much more likely to sign 3, 5, or even longer year contracts with the states to keep these portals open. Obviously, you start with a request for a proposal and you award a contract. That's step one. You launch the website, and that's where a modest investment from the company itself comes into play. And by modest, they mean somewhere between $500,000 and $1 million. That money is usually paid back within 12 months. It moves real quickly to their first portal. And in almost every single state, the first portal has something to do with the Department of Motor Vehicles. That's the foundation portal, and that's the place where all the other sites launch from. The portal usually includes things like being able to renew your driver's license online, maybe voter registration, maybe paying fees. In Michigan, for example, we pay a park fee if we choose to. And the portals go live after about after 3 to 6 months after the contract is signed, and then from the Department of Motor Vehicles portal, that's where the growth goes then, and that's in delivering non-DMV applications. And there's hundreds and hundreds of different types of applications depending on the state and depending on what they're looking for. I think some of them are listed on this slide, things like hunting and fishing licenses and birth certificates and death certificates, things like that. But it's a pretty simple business model which doesn't go into taxpayer money. They've been doing a lot of surveying, and they've found that most people do not mind paying a small amount to be able to avoid the lines in a typical government agency like the DMV. So a small fee to do your business online is usually something that people are very willing to pay. There's 4 types of portal revenue. Notice that about 40% of the total revenue comes from the DMV, and then another 45% is coming from the growth after that initial DMV portal from non-DMV services. In addition, they get about 5% of their revenue from management fees, recurring fees that happen on a regular basis in certain states, and then the last 10% of their revenue comes from projects that individual states ask them to deal with on a single instance basis, and those are non-recurring revenues. So we have about 85 to 90% of the revenue recurring on a regular basis and being secured by long-term contracts. Their growth drivers are the fact that once they get an initial portal in a state, the state becomes eager to add to the list of things that a person can do online. And besides dealing with just the state governments, the company is very interested in moving into the federal government and also moving into county and local government. They have a goal of adding 2 states a year, and right now they've had their first opportunity to cooperate with the federal government in the Department of Transportation. It's the Federal Motor Carrier Safety Administration. I doubt if very many of us have heard of that. And it's their pre-employment screening program. It's basically a way for trucking companies or people that use drivers can check safety records for new hires. Notice there were 600,000 records accessed in 2011 with $6 million in revenue. NIC feels this is just the first step in beginning to partner with the federal government in creating different opportunities for individuals and for corporations to interact with different databases and collect information that they might need or give information that might be required of them in different situations. That's the end of my slides. I'm going to go real quickly to my toolkit here. I love these small companies, and here we are with sales well under 125 million per quarter. That means the sales are well under 500 million per year, which classifies this by Better Investing language as a small company. Zero debt. I love small companies with no debt. And the classic definition coming from George Nicholson of growth in excess of 12% certainly is being demonstrated by these lines right here. We have, for the last 7 years, and I've gone back about that far because that's about as long as the company's been public. For the last 7 years, growth for sales has averaged about 21%, and for earnings around 19%. I've set growth going forward, even though the analysts are calling for growth around 25%, I've set growth at 18%, and by doing a preferred procedure, I've come up with estimated earnings per share growth of about 19%. I'm going to turn this over and just show you a beautiful set of metrics in Section 2. Profit margins that are on the upturn, especially off of the recession, right back to where they were before the recession. That's a great thing in my estimation. Return on equity that's just unbelievable almost. It's gone up in the last year to almost 42%. Usually anything over 20 is considered exceptional. So this company knows how to move the money to their shareholders by virtue of returning money on equity, and of course no debt for a long, long period of time. This kind of growth, this kind of stellar management of metrics, of course, gives us high PEs at the high side, and for that matter at the low side. I've moved with a high PE of 38 going forward. I know that might be a little bit aggressive for some of you in the audience, but this is my SSG, and I feel this very small company can stay at a high side PE in the 35 to 40 range for the next 4 or 5 years yet. I've moved the low at 24. That's a pretty aggressive low PE choice. I did adjust for the most recent 4 quarters. And I get returns that are a little bit higher than the returns that Mark shows on Manifest. I'm looking at 12.5 par up to 17% if I would sell at the highest PE that's available. I'm kind of basing a lot of my analysis on an average PE up around 30-31, and I think if you look on the Manifest site, you'll notice that Mark is basing his on a slightly lower PE, which will account for the slightly lower par that he's showing for the company. All in all, I really, really like everything that I've read about this company to this point. I have put a little bit of money into it myself. I find that if I don't put some money into a company, then I don't follow it as carefully as I should. So I'm disclosing that I do own a very small position in NIC, and I'm willing to see what it's going to do and where it's going to go. I'm going to add it to this portfolio as well, Mark. NIC. EGOV is the ticker.
Fascinating. Thanks, Ken. It's a interesting look. Why don't you go ahead and switch the screen over to Herb, and I'll go ahead and set the table for him. We invited Herb to come along tonight and share some ideas about stock picking. Herb is one of the leading members of the investment club who won the group entry in our Groundhog stock picking contest last year. And so he's part of the champion group. And by the way, 2 or 3 of the members of that club are near the top of the leaderboard for this year, including Herb. He's been hovering around first, third, or fourth place for the last couple of months, and he's right up there on the leaderboard right now. So we like to recognize those who demonstrate success in stock picking. So that's why we asked him to join us tonight. So as our guest tonight, filling in for Cy, take it away, Herb.
Thank you very much. Yeah, you know, being at the top of the leaderboard at this time of the game doesn't necessarily mean anything. You never know how long you're going to stay there. Of course, when you're at the top, you got nowhere to go but down. But we hope to stay up there. Charles Brunel and myself are part of the Northern Traders Investment Club, and we do enjoy our camaraderie and our getting together on a regular basis. So, you know, I looked around. Ken asked me to be part of it. And I looked around at each of the portfolios that I have either personally or as part of the stock club or whatever. And one of the stocks that came out was LKQ Corporation. And so I kind of looked it up to see where it's at, what it's doing, and why. And find out that they just announced that they're going to go for a 2-for-1 stock split with holders on the end of the on September or August 28th and payable on the 19th. So this is one of those stocks that I have held personally in my portfolio and been kind of very happy with it over the years. So it's got some challenges, which I listened to the report, and one of the things that they are doing is they're continually aggressively acquiring new companies. They've already acquired 7 companies. They've acquired 5 self-service companies in Maryland. They are really going after the growth in that direction. One of the things I thought was interesting is that they are purchasing of automobile parts, and they take in with those parts. They are then also buying automobiles to resell those parts in. Replacement parts for components and systems for repairing vehicles. So instead of buying from the major corporations that you go to this company and buy a used part and put it in your car, and then they make the money on buying those old junk cars or trashed cars. So they have purchased this year almost 67,000 vehicles, which is an 18% increase, and they also crunch cars only for steel, which is one of the challenges that they're looking at. Is that the steel prices are going down, scrap prices they've been kind of stable up until June and July, and then all of a sudden they've kind of dropped lower. So that's going to put some pressure on the third quarter, and they might start to recover in the fourth quarter. They are adding 3 new branches in United Kingdom, so this makes a company that's all over the world, and so that's also including some higher inventory costs that they not normally do. So it's kind of a neat little company. There was a branch, there still is a branch here in Traverse City that they took and recycled bumpers on cars. And one of my sons worked there for about 10 years, and fiberglassing and redoing the bumpers. And so that's kind of how I got to know the company a little bit. That's kind of one of those things that you just kind of look at, what are you going to do? Then I don't know, is it showing my toolkit now, Mark?
No, we're seeing the Yahoo page right now, Herb.
Okay.
There we go.
Is that showing it? There we go. Okay. So when I pull up my toolkit, you know, one of the things that we chant in northern Michigan is up, straight, and parallel. As you can see, the sales have increased in the last year, 32.5%. Earnings per share have gone up 34.4%. It is a major growing company. I have looked at it and said, you know, I'm not going to continue that growth. I'm only going to go at 20% on the growth. When I go to the back side, you can see that the debt is continually going up, but so the pre-tax profit on sales has kind of trickled down just a little bit, but return on equity has gone up. The current price of 38 is still quite a bit higher than what it was on his 52-week low at 22. I looked at the selected high PE of 19 because that's what the projected PE is on the toolkit. Even though the current PE is 22, I'm a little more conservative. Excuse me. I did select a 15.3 for the low PE, which is my average on the low PE, which gives me a 25. And when I look at that, I come down to that it's a buy range and a 3.3% upside downside. So I'm pretty well within that buy range. And when I get done, I have a compounded annual return of 15.7 or projected return of 13.4. So, which is a little bit higher than what Mark has got on his agenda. But, you know, I think that for the current time that you're going to see that the next year's growth, if I go back to, let's see, my Yahoo, and I go to and I look at analyst estimates and find out what the analysts are saying about LKQ Corporation. And as you can see, the earnings estimates are continually going up, $1.83 for this year and $2.21 for next year. The number of analysts are around 10 people, so it's not widely followed, but it's followed well enough. The revenue estimates, it looks like they're going from $4.13 billion to $4.56 billion. They did have a quarter of this last quarter of $1.1 billion, and they were really tickled. That's the first time they've been able to get to that point. They are continually looking up. All the analysts, as you can see, have 90 days ago had $2.6, 2.16, 2.2, 2.18, 2.22, and so the analyst estimates have gone up for the next year, and this year the analysts have taken it down just a little bit. So that's kind of my report on LKQ, and I appreciate the opportunity. This is the first time I've had a chance to do something like that, so a little bit outside my comfort zone.
Oh, we really appreciate it. You sure seem to be in your comfort zone, Herb. Appreciate you.
Well, I never had a problem talking, so I guess that helps.
You're doing fine. All right, Ken, if you want to switch the view back to me, and thanks a lot, Herb. We'll throw that in the tracking portfolio, and we'll root for an increased number of collisions and fender benders, just not to anybody that's here tonight. All right, let's spend just a couple seconds on, we've got a little bit of extra time. He was unable to join us tonight because of business travel, but he's given some fairly extensive presentations on a company very well known by the community. He would like to go ahead and include Staples in the portfolio as a repeat selection. And the story here is actually pretty direct and pretty simple. You either believe Staples is going out of business or not. And they were, as you can see in the middle of the picture there, fairly impacted by the recession here a few years ago. There are certainly pretty pervasive recessionary concerns right now. This gray shaded area here is the recession known as the recession, actually the Great Recession, the bear market that took place here. And you can see that the earnings were actually quite impaired during that time frame. Now, many people over the last several quarters have expected that type of recessionary behavior, particularly in that industry, to continue over the next several months. So they're basically going to be winding some of these longer-term earning estimates perhaps down. You could see them weaken a little bit. But in Hugh's viewpoint, he looks at a company that is one of the leading internet-based suppliers, obviously one of the top companies within that industry segment. Even in the crushing blow of a global recession, he thinks that they will continue on. nowhere near, the 10, 15, and the 20% growth rates of the past, but they can continue in the mid-single digits over the longer term. And so long as they stay viable and stay chunking along, he's basically looking at this as an outsized opportunity. You can see even at a higher stock price during the most recent Value Line Investment Survey company update, the low total return forecast, if the company stock price is restored to the level of 35 in their 3 to 5 year forecast, we're talking about on the order of 30% returns. Even if you shave off some of the fundamentals and you look for things like 3 to 4% sales growth and 4% net margins and maybe a little bit off the PE, maybe something in the 14-ish range, you still have a company that's in the 20% range or so, and that's why you see them where they're at on our tracking portfolio dashboard. So again, he wants to throw another log on the fire, basically accumulate staples. I think that'll be like a 4 or 5 time selection. And again, with a very long-term perspective in mind, knowing that the next several quarters could be quite bumpy. So we'll go ahead and throw that on the log on the fire for Mr. McManus, and I'll proceed with my pick for this month. As many of you know, we put out every actually Monday morning, we put out what we refer to as our panoramic screen. The reason we call it panoramic is because we basically take every update issue for Value Line, which you're basically looking at 1/13 of all the companies, and we look at companies of interest within the single issue that's being updated this week. Well, we wanted to add this to the same thing that we present on a weekly basis and include all 13 issues, basically include all 2,500 companies at Manifest, hence the title Panoramic Screen. We basically screen on very simple characteristics. As you guys know, we search for companies that are high quality with high return forecasts, and we basically combine those two characteristics that are shown here on the right-hand side of the display, quality and projected annual return, into a Manifest ranking. And we build this score that we refer to as the Manifest rank. So anytime that you're searching for the Manifest rank greater than 99, you're basically saying, Manifest Investing, I want the top 1%, the top percentile of all the stocks that are out there, and show me just those. And then we tack on one additional thing. We want companies that have strong balance sheets and pretty good fields of opportunity in front of them. So we want companies that have a financial strength rating of 70 or above. That's basically limiting the field of companies to the equivalent of a Value Line B++ and above. So anytime you see 70, think B++. So we want those and any of the companies that are rated A and higher at Manifest. That screen gives you this output of approximately 15 or 16 companies. What we've been tinkering with here lately is to basically we're not going to go into the subject in too much detail tonight, but we basically add one more element to this screen, and that is to color code these companies. And by the way, I caved. I didn't want to use green and red, but I finally caved on it. Any company depicted here in green or color coded in green when it comes to the company name and ticker is a company that has a bullish tendency based on what's happening with all the investors in the stock market as measured by what's happening to their stock price lately. So these are companies that are basically in favor. Go ahead, Ken. You have a question?
I'm going to break in with a question that really pertains. You indicated that every Monday you put this screen out. Where can they find it on the Manifest site? Martha would like to know where she could find this panoramic screen.
Okay, we posted every Monday morning in the general discussion, and then we actually put out a weekly message. It's kind of a memo that comes out later in the week, usually on Thursday or Friday, that will also have it. But if you want it on Monday morning, you can go and find it. I'll demonstrate where to find that when I'm done with my comments, so I can show you exactly where it's at. You can see this output for today. Okay, and then what I typically do every week is I think a little bit harder about the companies that are not only very strong purchase candidates from the perspective of their fundamentals and their high quality and all that stuff, but also companies that tend to be in favor. That's the green ones, the Apples, the BioReference Labs. And in this case, I'm going to sneak down, much like Ken and Cy often do, and look for a company that's down here in the kind of at the tipping point of the sweet spot and center in on Knight Transportation as my pick. I'm skipping over Infosys Technology, Coach, Ritchie Brothers, because those are companies that are bearish right now. And that what that simply means to me is that no matter how good the stock study looks, no matter how good they look on the visual analysis or the complete guide, for whatever reason, and this could be very short term, very temporary, Wall Street just doesn't like them right now. And the companies that are shown here in yellow are kind of in between. They're kind of in that toggle pattern. They could go either way. So again, I just say, hey, I'll come back and check again next week. But we'll just let those go. And what this allows me to do is take, this list of all 16 of these are, from a long-term perspective, pretty attractive purchase candidates for study. But I want to focus in on the ones that have better characteristics, right now in terms of supply and demand. You can almost think of it as upward pressure on the stock price, if you want to think of it that way. The ones in red have what you could think of as almost downward pressure on the stock price. So again, we're just getting a little bit nuanced with how we think about coming into these companies. And again, I don't know about you, but I don't necessarily want to study 16. I want to limit my field to 3 or 4 companies if I'm really looking for something to invest in. So let's go with Knight Transportation for tonight. Here's a look at Knight Transportation, and Knight Transportation is a really simple story. It's a trucking company. They specialize in all kinds of different hauls. It's you'll notice the company's on the freeways. They have refrigerated trucks. It's a company that's been established for many years. You will find, if you dig in a little bit deeper, it truly is family owned. In fact, very close to 50%, if not more than 50%, is owned by a family of brothers. So we are talking about a family-owned business here. So that carries its own considerations, obviously. This, again, is the type of company, anytime you do a stock study and you're looking at the visual analysis, when you're talking about a company that is relatively deeply affected by the recession, I think you should put the picture of the recession on here so you can see the pressure. You can see the downward pressure on earnings during that last recession. So again, if somebody were to sit across from you at the coffee table tomorrow and say, hey, I see a recession nearly as bad as the one that happened back in 2008, 2009, what do you think is going to happen to the earnings? And if you expect the earnings to go down, we know that the stock price will follow earnings, and you know that the price is going to take a hit. When I take a look at the company from a long-term perspective, though, I say, yeah, there could be a recession here within the next year or two, or a quarter or whatever, but longer term, this company has shown resilience and the pretty good bounce back here as we progress from left to right on this picture. You can see that the analyst estimates for 2012 and 2013 are pretty robust. So even though many of these analysts are thinking recessionary conditions, they still see a company handling the situation pretty well, being fairly competitive in all their trucking endeavors, doing pretty well. Last but not least, over here on the low total return forecast from Value Line, we do see a fairly decent number of 15%, so it continues to prove itself worthy for deeper study. So when taking a look at the company at Manifest, we basically see a company that has a return forecast somewhere in the upper teens, if not 20%. That is based on tonight's close. A high-quality company that's demonstrated pretty good business characteristics over the years, high financial strength. They have a tiny amount of long-term debt, but a company that's feasibly could grow in the 9 to 10% range, achieving, again, 8 to 9% net margins over the long term, with a PE coming in somewhere around 20. Again, looking at it from the Manifest perspective and fundamentals alone, it's a strong buy, rating in the top 1% or the top percentile of all companies. And we kind of have a double effect here of the company being attractive from a momentum standpoint with bullish sentiment. Again, this in fairly short order could be a company looking at a stock price of 22 or more. The one chink in the armor and the things that we look at Manifest Investing, the Motley Fools All-Stars only have a rating of 86%. That's well below average. Again, average is somewhere in that 91 to 92% range. So the successful stock pickers at the Motley Fool Caps stock picking experiment are not real bullish on this company. And again, a lot of that is because of the sensitivity to recessions. When we take a look, do a kind of a cross look, you can see that our numbers are not out of line compared to the PE expectations either at Value Line, S&P, or Morningstar. Again, fairly comparable financial strength ratings, fairly comparable growth forecasts, and you can see that Standard & Poor's is a little bit less optimistic with a hold rating on the company. Morningstar does have 4 stars, not a strong buy, but a buy. And the one caveat, or one thing I will mention here that it makes me a little bit skittish as an investor, my experience over the years has been that of all the entities involved here, between Value Line, S&P, and Morningstar, S&P probably does one of the better jobs of handling the impact of recessions. And the fact that these guys are only at 3 stars or a hold on a economically impacted or sensitive stock does give me a little bit of pause. But they do have a 1-year price target that's 10 to 15% above current price levels, and worthy of a closer look. So I'm going to go ahead and add night transportation to the portfolio, and again with the underscore that we're talking long term, and this could be sensitive to a hiccup should the recession deepen a little bit.
Mark, is this the first time for night in the transportation?
I think it is. I mean, it's
okay.
Not in there yet. So it is for this particular portfolio. It is. It's been in a number of our other model clubs, and I know it's been a Kavula family favorite for years. So
yeah, we've owned this stock for off and on for a long time. Yeah.
So with that, Ken, we'll go ahead and do a shameless plug for where we're going to be here in a couple of weeks.
Well, we'd love for any of you near the Houston area to join us at the Marriott Westchase in Houston, Texas, September 13th through the 16th for the Better Investing Annual Convention. If you can't make all 4 days, try coming for just the single day. Saturday especially is a particularly good day to come. It's almost completely free. You can come and visit the expo hall and talk to company representatives. And if you want to pay a few dollars, you can even attend a few classes. Other days of the week, you can attend a lot of classes on Friday. We do have great daily rates, good things going on in the afternoon and the evenings as well. So if you have a chance, we'd love to see you and chat with you. Mark will be there, Hugh will be there, and Cy will be there.
Okay, and I guess with that, if you do have any questions or comments following, if you want copies of the slides, you can feel free to email me. I will get that, manifest@manifestinvesting.com. Or if you have any follow-up questions on anything or things that you would like to see in the future. Ken, do you have a poll ready to go?
I do, and I'm going to post that poll right now. Mark, here goes.
All right, and here we're basically inviting you to, you heard 4 stocks mentioned here tonight. Go ahead and as an audience participant, go ahead and cast your vote.
Oh, I guess I don't get to vote, huh?
No, Herb, you've crossed over into the land of we don't let administrators and organizers vote. Now you get to feel you feel the pain that every challenge club I feel the pain, right?
Well, then I can join the club of Mark for the shameless promotion of the stock that I presented, huh?
It's not supposed to be a popularity contest.
Folks, all you have to do is press the button on your screen. I'm going to keep it open just a little bit longer. We have 80% of you voting already.
Well, I have to admit they're voting the way I would have voted.
Pushed up to 85.
Don't get a big head, Ken.
Okay, 2 more seconds here, folks. If you haven't voted, now's the time to make up your mind and push that percentage over 95. Okay, we're going to close the poll. Oops, I pressed the wrong button here, guys. Let's share the results. There we are.
Hey.
So we have 66% of our folks deciding that they'd like to add NIC to the roundtable portfolio. So we'll add it twice tonight then, once for my call and once for the audience's call. The audience has done a pretty good job in choosing stocks, hasn't it, Mark?
Yep, they're in there very well, and so have the guest damsels and the guest knights. Rue 21 still doing well for Nick Strategos, and I wouldn't be surprised to see LKQ to do all right.
Okay, so we would like, there's a question mark, would somebody like to tackle Gentex and talk a little bit about Gentex?
Okay, let's do two things. One of the first things I promised was to show everybody where that list is every week on Monday morning. It's usually there by 10 or 10:30 in the morning, depending on how much I partied the night before. No, I'm kidding. If you go into the Manifest forum, and again, if you're not familiar with Manifest investing, feel free to send me a note, and I'd be happy to give you a free trial so you can kick this stuff around. Those of you that are familiar, simply go into your forum, click on General Discussion, okay, and then under General Discussion, if you kind of just scroll down the page, you can see this week at Manifest, going back several weeks. You can go back a couple years if you want, but here is what we put up this morning. I'm going to add a kind of editorial commentary here in a few minutes, but a little bit of market barometers. This is what I was mentioning about. These are just the companies out of issue 2. Issue 2, the update for Value Line, and there's 6 companies there that kind of qualify as being potentially interesting, on a kind of a first cut basis. But down here is what Maureen was asking for. A look at the thing that was on my slide, and again, we put that out in the morning so that you can tell you where it comes from. Here's what it's about. But again, there is the list, and again, that's within the Manifest forum under General Discussion. And again, I'll just go back and show you. It's under This Week at Manifest. And then, like I said, Thursday or Friday, we do put it out as part of the weekly message that goes out, in many cases, even to the general public. So you can also subscribe for that newsletter. And if you don't know how to do that, go ahead and send me a note, and I'll help you out with that also. It's a free weekly message. And one of the other things that I do like to point out, especially when we're in a learning environment like this, when we do the updates every week at looking at the value line inputs, we watch for companies where their fundamentals have been ratcheted up so that their long-term price forecasts are either been increased or decreased. Those that have been increased or decreased by a disproportionately larger amount are the ones that are shown here. So if you either own or you're a stock watcher within a club and your company shows up here, in fact, here is Knight Transportation. They actually got dinged on the fundamentals a little bit with this particular report. If you actually go back a couple of quarters, you'll see that Value Line was probably being a little bit overly optimistic about the long term, and they've kind of returned to earth here a little bit. But if it's a company that you're responsible for following, or if you're an actual shareholder, you might watch for them to show up here, and then go in and audit or study and look for well, what's been changing here. Did they raise their profitability forecast, etc., or lower it? What's causing them to be materially weaker? And again, that's relative to all the other companies within the issue. Okay, that seemed to take care of those questions, Ken?
Yes, it did, Mark. You want to move to Gentex?
Okay, let's go ahead and I'll pull up Gentex over at Manifest. Can we get clarification about what the audience member is concerned about, or?
Yeah, could the person that would like to discuss Gentex tell us a little bit? It's Nick. Nick, can you tell us a little bit more about what you'd like to talk about with Gentex?
Nick may not have a microphone, so if he has to type in his response, I'll just point out that we're showing a company that is up at a fairly elevated projected return. We're talking about a company that has again, on the 11% growth forecast, net profit margin in the 16 to 17% range, and an average PE ratio of 21. I'm going to jump over to stock charts, and this will probably...
His question is about whether the recent drop in its price.
Yeah, and that's what we're seeing here. That's what I suspected he was probably after. Let's take a look at it over just the last year. And I don't know specifically what caused this downdraft in price in late July. Do either of you two guys know?
No, Mark, I don't follow this stock very closely.
I follow it very tangentially, so this is obviously a good company that's been around for quite a while. I do not know what that disruption was over. If I had to guess, they probably had an earnings report back in that time frame, and they probably blamed Europe because they make a lot of stuff for the European automotive manufacturers, and they probably had some fairly pessimistic words about what's going on in Europe, because the domestic auto industry is doing pretty good right now. And I think if you went back and looked, I would, again, without getting in any deeper, I would speculate that price drop was probably overblown. And anytime you see a relative strength index that zooms way down here below 30, what that's suggesting is that's potentially oversold. And it got all the way down to 15. It's not much higher than 15 now, and it's recovered back to 17. At 17, we still look at the company. We look at the current fundamentals of the company, a little over $1 billion in sales. We still see a fairly decent projected annual return for the company. So it still looks pretty good. And here's a longer-term look at the company. You can see that it's had some swoons in the past, which would have been quite rewarding to have invested in the company back in the, again, in the teeth of that bear market. But
Mark, I'm going way back to July 24th and getting a lot of headlines about Gentex shares plunging after they missed sales estimates. So their sales were not up to what Wall Street thought they should be, and that is what, at least what the papers are giving the reason that it got crushed.
Jane makes a comment that it happened because the U.S. government changed the date where all cars had to have the backup camera by 2014 to a later date to maybe 2016. It missed earnings and lost 4 customers for the rearview mirror cameras.
Okay, well, again, that to me sounds like at worst an intermediate problem, probably something that's going to come around. So my take on the company would be, again, from a fairly long-term perspective, let's take a look at Value Line.
The comment was the customers would rather put money into the entertainment system rather than the rearview mirror.
Well, that's no pun intended. That's music to our ears. That's what my wife works on at Chrysler. Here's a look at Gentex when it was in the $21 price range. Let's see what the date of this one is. A little bit out of date, so it's want to look a little bit closer at the fundamentals, updating for current statistics. But you can see that at a price of 21, if the fundamentals have not been dinged too much, we were looking at a low total return forecast of 16. So it's easy to make a case for something in the 20% range in the absence of any really, really detrimental impact on overall fundamentals. As Herb did a few minutes ago for LKQ, let's go ahead and take a look at Gentex.
Mark, while you're looking also, I've uncovered a couple of things here too, that they've had 4 of their major customers make a decision to put their cameras, the rear cameras, to put them in the console with the radio rather than in the mirror, and that will have a pretty big negative impact on 2013 and 2014 results. So future earnings are going to be impacted by the change in where that camera is going to be, where the display is going to be located.
Again, that could be good for our household, but I won't say any more. That will probably be reflected here, and it will ultimately be reflected in our estimates at Manifest. What we'll probably see is these revenue estimates go down. You can see if you go down the page, the earnings estimates have already taken a slight ding for 2012 and a pretty healthy ding for 2013. So again, that's one of the reasons when we do a visual analysis at Manifest, that's why you will see us paying an awful lot of attention to the years that are normally in the forecast portion of the visual analysis, because we embed that right in the trend. It's meaningful information, plus we monitor it continuously as that goes down. So I think that probably covers some of the highlights for Nick. I will go ahead and post an updated company summary on Gentex in the Manifest forum under stocks. And Nick and anybody else is welcome to chime in with any more information as to what's happening at the company. It's a great Michigan company, and I think as you study them, you'll find that they're diversified across many customers. So even as they lose some customers, they're pretty well diversified and distributed in their customer base. So that probably bodes well for them, but I'm sure they don't enjoy losing any contracts.
Mark, I read the comments from the different people that are part of the audience, so that was where I got my comments from.
As usual, the community is pretty powerful at digging out this kind of information.
I'm impressed with their knowledge.
It's also pretty obvious that there are some Gentex owners out there in this group of people watching us this evening. Yeah.
Yeah, it's the type of company that I respect deeply. So I don't, although we have family members who own the company, I really don't pay much attention to them, even quarter to quarter. They just keep chugging along.
I have cleared the question panel, Mark, with active questions, and there's no hands in the air.
Okay, well, with that, we'll just say good night, and thanks, everybody. Thank you, Herb, for your contributions, and see everybody soon.
Mark, we did get one question about Cognizant. That was Cy's choice last week, remember? Or last month. And Patty would like to know what, personally, what we've done about Cognizant in our personal portfolios. I can report that I'm a firm believer in listening carefully to the language, and I don't believe that the stock should have been punished by saying it's the acceleration of its growth was slowing, and so I held on to Cognizant, and I'm quite happy right now. It's made a nice return. It's moving back towards the $65, $70 range, and I'm very happy with holding Cognizant Technology right now. I don't know, do you or Herb hold it, either one of you?
I do, yes, and I'm very happy.
Yeah, same thing here. I don't hold it directly personally, but it is in a number of the model portfolios, and kind of the same attitude. You've got an extremely high quality rating on the company. This is another company that is going to just naturally be impacted by the global recession. You know, and my advice is take a deep breath, get over it. It's just going to happen. You got to think longer term. And this is a company that has exploited opportunity quite effectively over the years. There's no indication that that will cease. And as Ken was just saying, this company's getting bigger, folks. It's gotta grow at a slower rate. And I can speak from very significant personal experience. Anytime you're involved with a high-quality growth company that begins to slow down, and for the first time in a conference call they're honest about it, they get crushed. And that there could be at least a sliver of that going on here, where Cognizant has been honest about the opportunities ahead, the natural life cycle slowing of the company. And again, I would not be too panicked about it. It's pretty stable at such an extremely high quality rating, and unless that slips precipitously, that's the only time I would be concerned about the company.
Looks like we're getting a lot of thanks. So
I'm watching questions, and we're pretty clear.
Yep.
So I want to thank all the Mid-Michigan folks that attended this evening. As always, we do this first for you, but then we do it for everybody else in the country as well. And a special thanks to Herb for helping us out. Herb, we'll be sure to ask you again when we need a pinch hitter. Nice presentation on LKQ this evening. And Mark, as always, thank you so much for helping us out in providing education for our members. We appreciate it.
You're most welcome.
Thank you.
Thanks, and good night, everybody.